Hi, I'm Justin Williamson, Senior Partner and Certified Financial Planner with Center for Wealth Management. Today I want to talk to you about Roth conversion optimization strategies. So Roth retirement accounts, whether it's a 401k, 403b, IRA, or any other type of retirement plan, are some of the most frequently asked about plans that we get with the people that we talk to. And so I want to work through an idea called Roth conversions today. But before we get into that, let's first dive into the difference between a contribution and a conversion. So with contributions, these are typically amounts that are coming from your paycheck and going into these retirement accounts, whether it be your 401k or 403b, or secondarily as a Roth IRA contribution. So we'll start with the 401k, 403b accounts. These are going to be provided by your employer, and the contribution limit each year is up to $23,500 for 2025. It's generally indexed for inflation, but for 2025 we can put in $23,500 of our own money. If you're over age 50, there is a catch-up contribution also allowed. It's $7,500 per year into those plans. So we can do a total, if we're over age 50, of $31,000 again in 2025. For Roth IRAs, our contribution limit would be $7,000. So this, rather than participating in an employer-sponsored plan, and Roth IRA is going to be an individual retirement account. So it's not coming, in most cases, directly from our paycheck. The money first goes from our paycheck to our bank account, and then we'll make our contributions from there. But again, the maximum contribution for 2025, $7,000 for those under age 50, or $8,000 with that additional $1,000 catch-up contribution for those that are over age 50. So those are contributions where we're putting the money directly in from our paycheck or our bank account into these Roth retirement plans. The second way that we can get money, though, into a Roth account is through what's called a conversion. And a conversion means we're taking money from a pre-tax retirement account. So perhaps I've put in, let's say, $100,000 over my working career into a pre-tax retirement account where I got a tax deduction up front. The money has grown tax deferred since, and if I do nothing, I'll pay tax on all of that money when I take it out in retirement. To do a Roth conversion means I'm going to take some of that money today, let's say $10,000 of the $100,000, and I'm going to move it over to a Roth retirement account now. We can do this, and what happens is in the process of that $10,000 will become taxable income in the year of the conversion. So we take the $10,000, we move it over. Now in the Roth account, it will continue to grow tax deferred, but from that point forward, everything that it earns will be tax-free to us, provided we meet certain other criteria when we get into retirement. So those criteria are that we need to leave it for at least 5 years or to age 59 and a half, whichever is longer. And so as long as we give it that time to grow and leave the money inside the account, we'll have tax-free distributions for ourselves in retirement. So sometimes people ask, why would I do this? Well, what's the benefit to executing a Roth conversion? And generally it's the idea that we believe tax rates, through some means will be higher in the future. So by some means, what I mean to say is perhaps it's a situational circumstance where, let's say I'm making $150,000 a year today, but I don't need all of that income to live off of. So while I'm working and earning the $150,000 today, I would be in the 22% marginal tax bracket. But let's say I only needed $75,000 to live on in retirement. That would solidly place me into the 12% tax bracket in the future, again, based on today's rates. So by moving money, in that particular example, I probably don't want to do a Roth conversion because I'd be taking money today, paying 22% to later save myself 12%. That doesn't make a lot of sense. But let's just say it's the other way around. And today I feel like I'm in the 12% marginal tax bracket, but I think tax rates are ultimately going to go up in the future, whether it be because I want to spend more in retirement, I want to do more traveling, have more fun, and I would push myself into that higher tax bracket, or because in some cases, many of us just believe that tax rates will be higher in the future, that they won't stay this low forever. So if I believe that I'm paying 12% now, and I could end up paying a higher percentage later, it would make more sense to convert money from the pre-tax account to the Roth account now, say pay the 12% to avoid the 22% or higher later on. For our recently retired clients, this is something that we like to take a look at early on in retirement, especially if you're retiring, say, age 60 to 65, and even 65 to 70 or 75. There can be opportunity for you to do some of these conversions and make a lot of sense of it. I'll give you an example. Let's say that you've done a good job of saving in different places for your retirement. Maybe you've got your pre-tax retirement accounts, you might have some Roth money, you might have some taxable investments that are not inside of a retirement plan, but rather get those capital gains treatments. Well, if we can figure out a way early in retirement for you to live off of some of these more tax-favored investments and keep your taxable income low, what that allows us to do is an opportunity to take money from the pre-tax retirement accounts while your income is low, move it over to the Roth, and again, pay those low tax rates early on in retirement. This can be incredibly beneficial for clients that we see day in, day out. They've done most of their savings into pre-tax retirement accounts leading up to retirement. And it's great that they've done all that saving. The problem sometimes becomes that they're essentially sitting on a ticking tax time bomb. And what I mean by that is, with those pre-tax retirement accounts, there is going to come a day where you're going to have to take what are called required minimum distributions. Today, that age is 73. It will go up over the next several years to age 75. But whenever that age happens to be for you, when you need to start taking those required distributions, many times what we see is those distributions are more than what you actually need to live on. And when we add those to your Social Security that you're likely collecting at that point in time, it may push you into that next higher tax bracket inadvertently. So through no fault of your own, simply because you have to take these distributions, you end up paying a higher tax rate than what you would have otherwise. By doing Roth conversions prior to required distribution age, we can help to effectively lower those required distributions in the future and give ourselves more control over the tax bracket that we're in throughout retirement. A couple of things that we need to keep in mind as we talk about Roth conversions or think about is how they're going to, number one, impact our other income. So if I'm collecting, let's say, Social Security at 65, and that's the only income I have, there's a good chance I'm not paying any tax on my Social Security benefit. If I then go do a $50,000 Roth conversion, there's also a good chance I've now made much of my Social Security benefit taxable that otherwise wouldn't have been. And so instead of paying just the 12% that I thought I was going to pay on the conversion itself, I end up paying 12% on a lot of my Social Security income as well, effectively doubling the tax impact of that conversion. So that's something that we want to pay attention to and be aware of before we go ahead and execute a transaction such as this. Another point of concern with a Roth conversion is that each conversion has what they call a 5-year rule. What that means is, from the time I do the conversion, if I execute that conversion, I have to wait 5 years before I can pull that money out and get that tax-free treatment on the gain portion. And that's every conversion I do. If I do one in 2025, 2026, and 27, each of those 3 distributions or conversions will have its own 5-year period that I have to keep track of. Additionally, we want to be cautious with Roth conversions about how we're paying the taxes. If you're over 59 and a half, it's not as much of a concern. There's 2 ways you can do it. You can either have the tax withheld from the conversion amount itself. So if I want to convert 10,000, I could say withhold 20% for federal income tax, and $8,000 effectively goes into my Roth IRA, $2,000 goes to the government to pay the tax bill. If though I'm under 59 and a half and I have that tax withheld from the conversion amount, it is categorized as a premature distribution, no different than if you were to take money out of your retirement plan prior to 59 and a half in any other way, shape, or form. So now, not only do I have tax on the conversion, I've got tax on the money that I sent to the government, plus a 10% penalty on that amount that I had withheld for taxes. So not the best idea. If we're going to do that conversion, we want to figure out how we're going to pay the tax bill from another account, especially for those that are under 59 and a half. Again, over 59 and a half, you can kind of pick and choose how you're going to do it. But if you're under 59 and a half, certainly want to pay attention to that. So bottom line, Roth conversions can be a very useful strategy as far as our retirement planning goes. it is something that you should certainly be taking a look at on an annual basis. If you have questions about how these Roth conversions might help your situation, we'd be happy to help. Please give us a call. We look forward to talking to you soon.